Well, you've had a ride this week if you're an investor in chip stocks riding the AI boom. We'll talk about what spooked the markets in just a second. But first of all, in Australia this week, the ASX 200 down 0.7% for the week. We got an inflation reading from the ABS. Headline inflation fell to 4%. That's good. But the line we've got to keep an eye on is that blue one. That's the trim mean inflation that the RBA watches, and that actually rose from 3.4 to 3.6%. The ABS also released its household spending indicator this week. Household spending up 1.3% in May. And if you drill down into it, people were spending on hotels, cafes and restaurants. Discretionary spending up 2.1% for the month. Over in the US, the Nasdaq had a rough old week, down 4.5% for the week. The S&P 500 down 2%. And the SOX index, the index of chip stocks, down 7.5% for the week. So what's going on there? Well, I think there's two things. Number one, there's this growing realization that interest rates could be on the rise in America. If you want to deep dive into that, check out last week's video. And the other big question chip investors are grappling with is what's going on with the Magnificent Seven? Are they changing from these asset light, high margin, dominant cash machines to something a little bit different? We took a deep dive into Meta this week. It's been beaten down pretty heavily this year, and we went looking for value. Now, before I start the analysis, just want to be clear, it's been historically one of the world's best operating businesses, and you can see that on this chart. This is its ROA. This is what we use to determine business quality, and as you can see, it has been historically excellent. Their business model, well, it's basically keeping our eyeballs glued to its products, Facebook, Instagram, WhatsApp, for as long as possible. And AI helps them to do that. It helps them understand what you're watching, and it makes them more valuable to advertisers. Now, just say Meta wanted to stop all of this AI spending. Well, they couldn't, because their competitors like Google and TikTok will keep on spending. So they've been drawn into this spending war in AI. And you can see that when you have a look at their asset turnover. This is how many dollars of sales they extract from their assets, and it is declining. And that's because its asset base is growing, all of those data centers, all of those computer chips. We also took a look at its cash flows, and it was interesting, last year Meta paid out more to shareholders than it generated in free cash flow. Now, it's still a great business. Its balance sheet is an absolute fortress, but it is interesting that the cash is being consumed by these data center investments. So I guess as investors, if you're thinking about buying the Magnificent Seven at the moment, you've got to decide for stocks like Meta, are they still just an advertising company, or are they now an advertising company that's plugged into a giant power station? With all the uncertainty, we put fair value at about $380 a share. So this isn't just an issue that Meta are grappling with. Investors in all the Magnificent Seven companies are asking the same question. Will all this AI spending show up as profits eventually? And I think the answer to that is going to determine where the markets go for the rest of the year. All right, well, that's a wrap. If there's a company you ever want me to take a look at, or you've got a question, please just reach out. Stay calm, play the long game, and good luck with your investing.